Okay, good morning, everybody, and thank you for joining today's session. Again, my name is Adam Goldstein, the Chief Business Officer of the Federal Home Loan Bank of New York. We welcome you to today's webinar. This is our 6th webinar, and when I woke up this morning, I was kind of excited to have Brian Jones, our financial economist, back on to talk to us. There was a lot of requests from the surveys to have Brian come back, and then I saw the Dow futures. It looks like they were plummeting, and right now, as we talk, the Dow is down over 1,000 points. So no better time than to hear from our economist, and right now with all the uncertainty going on in the market. So just a few quick notes before we get started. If you have any questions, please submit them at any time through the question box, and they will be answered at the end. We continue to keep these webinars allotted to the allotted times to respect your schedule. So we will keep this to 45 minutes as we have for the other webinars that we've held. As a response to the COVID crisis, we've created this weekly webinar series to bring this education to our members, and we ask you kindly to complete the survey at the end so we have timely topics. As a matter of fact, next week we're going to be having a webinar on the important topic of credit and credit scores. We think it's important to show that kind of transparency to our membership about how we observe your financial conditions, the things that we look at, what your credit score is, what it means, what our escalation policy is, and whatnot. We're also trying to line up for the week after that a webinar on a LIBOR transition by the head of our LIBOR transition office, Ray Shinazuka. If you haven't had a moment, I would encourage you to go to our website and our financial intelligence library. There's a lot of good content there, and one of the things that's there is a series of podcasts. They're super brief, just a couple minutes each. And Tom Citino, our Vice President of Member Relations, and Ray Shinazuka kind of have a discussion about LIBOR transition and what's happening. And in anticipation of the upcoming webinar on that topic, we encourage you to check out that podcast. There's also lots of good content on that COVID-19 page about dividend announcements, PPP loans that we're accepting as eligible collateral, our disaster relief funding availability, and some tidbits about how you can use that to benefit your communities. So with that, I'd like to turn the webinar over to our Vice President of Member Relations and my good friend Tom Citino to kick off what no doubt will be an interesting discussion about the economy, and I'm sure there's going to be lots of good questions about what's happening in equities and bonds. So Tom, you want to take it away?
Sure. Thanks, Adam. Appreciate it. Good morning, everybody. So this is our second economic webinar, including Brian Jones. So just a little background information on Brian. Brian's our financial economist, and he's been at the bank just about 3 years. He just celebrated his 3-year anniversary, and he's been a real valuable resource to the bank and also to our members. Oftentimes he does private meetings with our member institutions, whether it be their ALCO committee, management teams, or their board of directors. So that's available to everyone, just to let you know. So Brian, prior experience before getting to the bank, he worked at a number of leading domestic and foreign financial institutions, and his experience included stints at Societe Generale, Citibank, Solomon Smith Barney, Solomon Brothers before it merged with Smith Barney, Lloyd's Bank, and also Urban Trust. So today, Brian provides macroeconomic analysis and strategic insight, which is utilized throughout our organization. And then he also provides useful regional economic analysis, which he includes in publications, and also, like I had mentioned before, he utilizes them when he addresses the management teams and boards of our member institutions. So that's valuable information. So with that said, please, like Adam had mentioned, it's going to be a interactive session. So please, as questions arise, please give us the questions and shoot them to us in the questions box on the right side of the screen. So with that being said, Brian, take it away.
Okay, good morning, everybody. I think that in order, before we get to taking a look at where we may be headed in the weeks and months ahead, it's instructive to look at where we probably are right now. We only have first quarter GDP figures. The way things lay out, we're not even going to get our first look at second quarter growth until we get to July. At least the data we have in hand right now, we've got full April figures, a smattering of May data. It suggests that we probably suffered the largest contraction in economic activity since the Great Depression. The biggest decline we've had in the post-war period was a 10% decline in the late 1950s. But given the data that we have in hand right now, it looks like the downturn is going to exceed that by a country mile. Right now, the estimates that we're looking at, depending on whose figures you look at, we're looking at a decline of somewhere between 25 and almost 50%. What I think is probably the best way of looking at it is you might as well just take the average, because given the limited information that we have in hand and the uncertainty with these estimates, you might as well just average across forecasts. The average right now is calling for about a 35% decline in activity in the second quarter. Broad look at what the bounce back might look like over the balance of the year is assuming that we get that 35-36% drop. The consensus is essentially calling for what I think most of us would call a U or a dampened V bounce back in activity. Right now, the call is that we're probably going to get about a 15.5% increase in growth during the summer quarter, followed by an 8% increase in the final 3 months of the year. The interesting thing about those numbers is that they would leave growth over the course of calendar 2020 down a little over 6%, which is essentially what the Fed was projecting yesterday when they came out with their estimates following the FOMC meeting. The Fed is looking for a 6.5% downturn over the course of this year, followed by a 5% bounce back next year and a 3.5% increase in 2022. I think what's important in those numbers is the Fed is telling you that they don't think we're going to get back to where we were at the tail end of 2019 until sometime in 2022. And we've got a lot of ground to make up. And I think that's partially responsible for what you're seeing in the equity market today. I mean, the equity market yesterday initially, took a favorable view of the Federal Reserve's expectation that they'll leave the federal funds rate constant all the way through the end of 2022. But I think what happened overnight is the people actually had some time on their hands and took a glance at what those interest rate projections implied for key economic figures, and that is basically that growth is going to be subdued, and that the unemployment rate is going to remain elevated for some time. The Fed did not change their estimate of what they think full employment is, which is for a little bit over 4%, but they're expecting us to end the year with the unemployment lower at 9.3%, ending next year at 6.5%, and 2022 at 5.5%. What's important in those numbers is that they imply that the coronavirus crisis is going to result in permanent job losses. A lot of the jobs that we've seen shed over the last 3 months, you're probably not going to get them back, or at least the Fed is expecting that you're not going to get them back. Looking at where we are beyond the current quarter, there are signs of life in the economy, though, that I think the people are starting to notice more and more. Just as far as the labor market's concerned, last Friday's jobs report was very surprising. That we actually added 2.5 million positions, in contrast to expectations of losing 7.5. I think what's probably happening there is that you're seeing the results of the PPP program kick in. And again, we have started to see, although they remain highly elevated, we have started to see declines in initial claims and, more importantly, continuing claims. Going forward, I think the continuing claims figures are the ones that are far more important to look at, because you can have a high level of initial claims, but the continuing claims figures are the total number of people on state benefit rolls. It's almost, the analogy I always use is one of a bathtub. Initial claims is the flow of water into the tub. Continuing claims is the level of water therein. But as people do return to work, you should start to see a precipitous decline in continuing claims over the next several weeks. They're still elevated. As of this morning's report, we're still above 20 million on continuing claims. The job gains that we did have last month, they were widespread across the economy, but the encouraging sign is that they were concentrated largely in 2 sectors which had been hit really hard by the closure of the economy and the social distancing restrictions, retail trade in particular, and leisure and hospitality. And we did get a nice bounce back in construction employment, primarily specialty trades, which I don't think were as constrained as the broader construction segments of employment were during the month. We are starting to see significant signs of life in consumer spending. Again, I don't think this report gets much airplay. This data gets much airplay because it comes out in drips and drabs across individual manufacturers. But auto sales bounced off their all-time low in April, and they were up a little bit over 40% last month. So you should get a pretty decent-sized contribution to the upcoming retail sales report from the automotive sector. Other areas of the economy that are showing some signs of life as well are restaurant sales, which is on the left-hand side panel of this chart, and even hotel occupancy rates, which are on the right-hand side. If you look at the restaurant bookings chart on the left, what you are seeing is that you're seeing a gradual return to normalcy across areas of the country that have returned to business, in particular Texas, Florida, Georgia, and California. We're all the way at the bottom. We've yet to pick up steam, and that's basically because we didn't enter phase 2 until this Tuesday. I mean, I took advantage of us entering phase 2, and I got a new haircut, which I desperately needed. As far as the right-hand side is concerned, we are seeing a pickup in hotel reservations as well, and occupancy rates, while nowhere near where they normally would be, they are at least moving higher. Other areas that suggest that things are coming back to normal is that you look at consumer mobility trends. Consumers' requests for driving directions are about 24% above where they were at the beginning of the year, and we have started to see a gradual pickup in gasoline consumption on a year-over-year basis. I mean, we're still about 20% below where we were last year on gasoline consumption, but again, those numbers are trending higher as well as people get out. There are areas that are going to have a tough time going forward, two in particular. One is airline travel, which we're getting better, but the pace is glacial. We're still down about 80% change below the levels of passenger miles that we were last year. And also, needless to say, movie theater sales. That may also be a function not just of the social distancing, but there really aren't any. There haven't really been any blockbuster movies announced. That's partially because people can't go to the theater anyway. As far as inflation in this environment, inflation is not, at least it's perceived not to be a problem for the Federal Reserve for any time over the forecast horizon. They're sticking to their 2% target on overall consumer price inflation. But given what they did with their GDP estimates yesterday and their unemployment rate forecast, they really took a hatchet to their inflation estimates. They expect that year-over-year overall inflation is just going to be up 0.8% this year, and 1% if we exclude core food and energy measures. And they don't have any return to the 2% target over the forecast horizon, which extends to the end of 2022. They're expecting that by that time, both the overall and core measures will still be about a quarter point shy of where they'd like to see them. Financial conditions have improved. They were, at least until the Fed announcement yesterday and the market started to digest the implications of the growth targets, we were getting close to neutral on financial conditions as measured by equity prices, market volatility measures, and money and bond market spreads. The important thing here, I think, to note is how quickly conditions have started to get better, notwithstanding what's happened today. I mean, in the 2008-2009 financial crisis, it took almost 2.5 years for financial conditions to get back to neutral. We've come within a fair amount of distance to neutral in just a matter of weeks. And I think that basically speaks to how aggressive both the Fed and Congress were in trying to support the economy in this environment. The Fed, not only have they left the funds rate near the lower bound of 0 to 0.25%, but they've also ramped up their securities purchases. Fiscal policies added about 2.6 trillion to the economy, the four packages that we have in place, and Fed holdings of securities have risen by about 2 trillion since the crisis began. So that's, together over 4.5 trillion of potential stimulus to the economy. As far as interest rates, and again, this chart probably needs a rinse and a blow dry given what happened in the wake of the Fed meeting. They basically, I think I would take anybody's interest rates forecast, including my own, with more than a few grains of salt. But there's an old adage in economics that give them a rate, give them a date, but never give them both. But basically, consensus expectations is that we will have a gradual increase in Treasury yields and a steepening of the yield curve into the summer of next year. As far as our own area, things are still contracting, although at a significantly slower rate than in the month of April. Manufacturing activity has started to the rate of decline has slowed, and we're almost back to being stable. The encouraging thing in the manufacturing sector is that even amidst the worst of the crisis, local manufacturers in the New York area were still optimistic that things would improve over the next 6 months. In fact, the future manufacturing gauge that we estimate from raw data from the New York Fed, and that's in the right-hand side panel of this chart, it never moved below the 50-point mark. The service sector is another story. Again, these are the segments of the economy that were most adversely impacted by the social distancing restrictions and closures of the economy. The service sector still is barely off its bottom that it reached in April. So we've got a long way to go with the service producing industries in the Fed's district, which includes northern New Jersey and southern Connecticut. But the encouraging thing, at least in the latest report, there was at least a return to somewhat normalcy on service-producing firms' expectations of what business activity and the business climate would be 6 months out. As far as jobless claims in the district, in the Federal Reserve District, which includes New York, New Jersey, Puerto Rico, and the Virgin Islands, they have come down a lot. As of this morning's report, initial claims were up a little bit from the prior week, and these figures are not seasonally adjusted, so there might be some seasonal impact there. But right now, the total number of people collecting benefits in the 2 states and 2 territories is down by about 280,000 since the peak that we hit in the crisis. I think you will see, we don't get the state employment numbers until a week from this Friday, but my guess is you will see probably surprisingly good numbers from the national report. And again, things going beyond the survey period in the May report look like things have started to improve. As far as one area of the economy that I would keep an eye on as we come out of this, as we come out of the shuttering of the economy, we know that we should get picked up in consumer spending. Next week's retail sales should be pretty good, although it probably won't counter all of the weakness that we saw in April. But the one area that I would look at for additional support to the economy is the housing sector. Even in the first quarter, where growth contracted 5%, there was a pretty decent-sized increase in residential investment of approximately 20%, which added almost 3/4 of a percentage point to growth. Lower interest rates, in particular lower mortgage interest rates, will support potential housing activity. And the most encouraging sign in the housing market right now is that after falling substantially in the wake of the coronavirus crisis, over the last 8 weeks, home purchase mortgage applications have risen a little bit over 70%, and they're within spitting distance of the expansion high that we hit in January. So that's going to be an area where I would suspect we'll get an added lift as we come out of this thing. As far as the mortgage performance, things are gradually improving. We will get a pickup in delinquencies in the second quarter. We know that's probably baked in the cake because of what's been going on. We may not see it in the foreclosure numbers because there have been some constraints on foreclosures because of the CARES Act. But what we also have seen is that the percent of services portfolio volumes that are in forbearance, they've started to flatten out. As of the data that was released last week, we're at about 8.5% of the portfolio is in forbearance, and the total number of consumers out there that are taking advantage of forbearance is about 4.3 million homeowners. These, I think, are amongst the most important data to watch. The coronavirus statistics, which come out every day, the testing numbers. Basically, for an economy our size, we're still probably not testing as many people daily as we should. I mean, for an economy our size, depending on whose estimate you go with, we should probably be conducting somewhere between 700,000 to 900,000 tests per day. But we have been consistently approaching, the 500,000 mark on a trailing weekly basis, and the percent positives are still a little bit above 4%. I mean, you'd like to see those south of 4%, but again, those are other numbers to watch aside from the economic statistics. I mean, the final thing that you can see that's also suggests that that the worst is behind us is that if you look at the advances of that are made by the Federal Home Loan Bank of New York. I mean, there's a trend, like most economic variables, they trend through time. They increase. So you really want to look at where advances are versus what that trend line is. And you can see from this chart that advances do go significantly above trend in the midst of a crisis, whether it's the 08 or 09 financial crisis or the current environment that we're in right now. But you can see that at least advances have started to they remain elevated, but they have started to come down, which suggests that the worst of the malaise that we've been in the wake of this virus may also be behind us. And with that, I'd be happy to answer any questions that you might have. Start a dialogue.
Sure. Hey, thanks a lot, Brian. I had a question myself. This is Tom Statino. By the way, the question kind of circles back to what Adam had started out the webinar discussing, talking about today's turbulence in the equity markets. What was the main piece of the new news that came out yesterday that has really impacted the equity markets and investor sentiment to cause such a rapid decline in the overall market? Because
I think
yeah, good.
If you look at it in a time-lapse fashion, I think the market yesterday, when the initial statement came out, reacted favorably to the fact that the Fed left the funds rate where it was, 0 to 0.25%, and also that the infamous dot plot showed that, with the exception of 2 people in 2020, all policymakers, so the members of the board and district bank presidents, universally don't see themselves doing anything on the interest rate front for the next 3 years. I think what got things going after that was that people looked at what was behind that. And look, the equity market's a discounting mechanism, and there's always going to be a fair amount of hope in equity pricing. And I think the equity market was probably it was probably performing more in line with a very V-shaped recovery. And you can understand those expectations given how surprisingly good the May jobs report was. But I think when they got a chance to look at the Fed's numbers, they said, hey guys, they don't have growth returning to where it was at the end of last year until sometime in 2021. And not only that, their unemployment rate projections imply that we're not going to get all of these jobs back. So I think basically it was that was their reality check. The only thing that I would also point out about the Fed's estimates is that there's a tremendous amount of uncertainty in these numbers. The ranges on their estimates are extremely wide. I mean, I'll give you an example. In the December meeting, their range for the unemployment rate at the end of this year was somewhere between 3.3%, 3.8%. That range now is between 7% and 14%. So, I mean, what's also embedded in their forecast is not only are the forecasts pessimistic, I think, vis-a-vis what the markets were looking for, but they've also, and this probably hasn't gotten as much focus, is that the uncertainty surrounding those estimates is much greater than I think people might have been expecting.
Right. All right. Thanks, Brian. With regards to short-term rates, the discussion yesterday at the FOMC indicated that it's going to remain static for around 3 years. What's your opinion on that? I mean, could things tighten up quicker if we do get a V-shaped recovery, or you think that's kind of pie in the sky and we're in this for another couple of years?
Well, I think the problem with interest rate forecasting is nobody does it well. I mean, if you've got a decent interest rate forecast, a year ahead out, I mean, it was probably just purely luck that you hit it. I mean, I think the reason why I think the Fed's got a lot of leeway to leave the funds rate where it is for an extended period of time is those inflation numbers. I mean, granted, they could be wrong on growth, they could be wrong on unemployment, but they don't have inflation getting back to their 2% target over their forecast horizon. So, I mean, even if growth picks up steam, if unemployment improves more quickly than you anticipate, what's the justification if inflation's not moving up as well? So I think in order to change that forecast, to change the dot plot, you would need to have an acceleration in economic activity and drop in the unemployment rate that makes them do a rethink on their inflation forecast. And I just don't see that anytime soon. I mean, this year we're not going to get 2% over the next 2 years easily, but I think the risk is that the numbers are probably going to move lower. I mean, the one segment that stands out in the CPI reports that we get every month in the last few months is, I mean, airline passenger fares. I mean, they're going down. Clothing prices have been coming down, and I think even when demand starts to pick up, I mean, airline fares I don't think are going anywhere anytime soon because you just don't have travelers. So I mean, again, I think remember they have a dual mandate. They want maximum employment and stable inflation, which they consider symmetric around a 2% target. And if you think about it right now, that's the dual mandate. Man, they're a long way from it right now.
Okay, Brian, thank you. So we do have
Welcome.
A few questions from attendees, and I want to turn it over to Alyssa to pose those questions. Do you have those questions, Alyssa?
Good morning. Yes. The first question is, thank you, Tom. What will it take for the economy to get back to full employment, and what unemployment level is the quote-unquote new normal, considering the amount of permanent job losses that will occur?
Well, I mean, I would take the Fed's 4.1% as the longer run estimate of what full employment is, and that really hasn't changed. I mean, essentially in the forecast, that's just saying that it's going to take us a long time to make up the destruction that we've suffered in the wake of this thing. But I don't think their views on what full employment have changed. And if you think about it, I mean, their estimate of full employment was actually about almost a half to 3/4 of a percentage point above what we actually experienced in the midst of the expansion. I don't think those numbers change. I think again, it's the forecast that has to change, the forecast versus the actuals, because there are certain things that the Fed based.
Okay, go ahead.
Yeah.
There are
certain
questions.
There are certain things that the Fed. There are certain things that the Fed hasn't moved. I mean, they haven't moved their unemployment. They haven't moved. There's been very little change to what they think the longer run estimates are of GDP at around 1.8%, unemployment 4.1%, or inflation at 2%. So again, I mean, these are the things that I think they have cemented in, and what determines policy is how far we are away from those targets. What would it take
You were mentioning that nationwide is going to be a unemployment, a target full employment of 4.2%. What do you think about more of the hard-hit, the areas that were more hard-hit with the coronavirus, such as New York City? I mean, do you anticipate that to be elevated over that 4%?
Well, again, the full employment numbers, I mean, they're kind of like, they're kind of set in stone. I mean, before the crisis, our area, the Federal Home Loan Bank in New York, we were running a little bit above the national average, basically because we also have Puerto Rico, which has chronically high unemployment rate, and the Virgin Islands. But I think, 4.1 to 4.5%, it's probably a decent metric for our area. I think the biggest problem that you're going to have is that what's crucial for us is the speed of reopening. It's almost as if you're in a race against time here with a lot of the industries, in particular the service sector, restaurants and things like that. I mean, the analogy I use, it's like a person who's got gangrene in one of their toes. If I can get you the doctor right away, and we take some antibiotics and we'll solve this thing. But the longer this thing goes on, we lose the toe, potentially lose the foot, and eventually you lose the leg. So I think what's crucial here is the speed with which we reopen these segments of the economy that have been really adversely impacted.
Okay, thank you.
Alyssa?
Okay.
The next question, are there, and I think this is a good follow-up to the previous, are there any permanent consumer behavior changes or any other environmental changes that could potentially be a drag on the recovery?
Well, the environmental thing, I think, probably that could go in either direction. I mean, there could be behavioral changes on consumers, for example, going out to restaurants. They may want restaurants that have more distancing, which means that if I run a restaurant that previously had 100 tables in it, I might have to cut back the number of tables to say 50 to 75. The problem there is to make up the revenue, I'm probably going to have to charge more per meal. I think you're going to see a lot more money spent on healthcare and things like that going forward. I think the one thing coming out of this crisis that is certainly permanent is that healthcare and the healthcare sector, it's going to become part of national defense policy. I mean, if you think about it, this virus was able to do things to the economy that the recent wars haven't been able to do. So I think there's going to be a rethink on a variety of things, in particular healthcare in this country.
Okay, and Brian, the last question that we have is, what do you think about the prospect of negative rates? Will the Fed ever consider allowing negative rates to occur?
I don't think that is the one thing that the Fed seems to be unanimous about when you read the minutes of the recent meetings. It's just an area that they just don't want to even contemplate. Basically because unlike a lot of the economies that have introduced negative interest rates, we have a much more well-developed money market industry than they do. The other thing too is that I think the evidence is that negative interest rates don't do what you want them to do. I mean, what is the point of negative interest rates? The point of negative interest rates is I do not want people to save or invest. I want them to spend. I want them to take this money and spend it now because it's not going to be worth as much. They won't have as much money going forward if they put it in a bank account. I don't think the Fed wants to go near the whole interest rates. I think negative interest rates, they view as perverse. I mean, just intuitively. I mean, I'm going to give you $100 and you're going to give me $9.95 back, say, at the end of the year. I mean, you'd be better off, get yourself a steel mattress or a safe rather than put money in that way. I mean, I guess you could. I mean, the way you get charged would be if you have a safe deposit box. But no, I think the next thing that the Fed would contemplate, if there's a perception that this thing is dragging along, they'll do yield curve targeting. I mean, at the end of the Second World War, the Fed had to maintain certain levels of interest rates in order to pay off the debt that we incurred during the war. It wasn't until they came to an agreement, the accord between the Fed and the Treasury, which allowed the Fed to start conducting independent monetary policy and letting interest rates go where they might go. But I could see, the Fed saying that, look, we're going to target 10-year notes, which mortgages are priced off. They're around 70 basis points today. Well, let's make them 25. Let's take down the bond. Instead of it trading at 1.5% on a constant maturity basis, let's bring it south of 1%. That, I think, is the next thing that the Fed would consider. They consider that before negative interest rates.
Okay. Any other questions?
Oh, thank you. No, that was the last one. Yep.
All right. Thanks a lot, Alyssa. Well, thank you, Brian. I appreciate your insights today and sharing them with our membership. So that concludes our session for today. Be sure to look out for a webinar invite on next week's webinar on Thursday, 11 o'clock, and that's going to be on the credit review process at the Home Loan Bank. That's really important to understand because it impacts borrowing potential of our members. Especially, it's good to get an understanding on how we view our members' strengths, especially during this time of economic turbulence. So that concludes our session for today. Please leave comments at the end of when you sign off, because that helps us provide content and provide better programming for you going forward. So have a great day, everyone. Be safe, and thanks for attending.